All right, today it's day 32 of the US Investing Championship, and unfortunately, I am down versus year to date versus the S&P 500. Uh, yeah, I think this is the second time that this happened. So today, well, but as I promised, I share with you my wins, my losses, and what I'm learning in the process, right? So today's topic is stock repair through options. And in this video, you learn how to recover from big stock losses using options. And I'll show you exactly what you can do. Now, not financial advice, obviously, but if you're new to the channel, this channel is all about documenting my 2026 US Investing Championship journey. I share with you my wins, my losses, and what I'm learning in the process. I basically open up, even my accounts so that yeah, I mean, full transparency. So that by doing it that way, number one, I benefit in the process because this is kind of like my trade journal in video format, and at the same time, you guys can benefit too, so that all of us become profitable trader and investor. All right. Okay, so let me show you my live accounts right now so that, I'll show you that everything is for real here. So, unfortunately, today is not so good as I said, right? So, I'm actually down today, and a big part of being down right now is, let me show you the symbol PNL. There are two uh, tickers that pulled down my account significantly. One is iron. I was down $379.04. And the other one is Palo Alto Networks, down $406.05. So for iron, right? So it was, so the setup was a bullish long call butterfly and then a out of the money put, okay, in order to protect the downside. But unfortunately, the price, so I was hoping that the price will stay and even go up, in which case, the whole position is profitable, or this thing crashed down really hard because if the price goes down below the $35 long put, specifically because of the cost of it. If it goes below $34, then it becomes profitable, right? But in between, that's the problem. And that's exactly what happened, right? So, and that's why I lost $379.04. Now, I could have, on hindsight, should have done, a twin butterfly strategy so that if ever it goes down, because it actually went down all the way to, well, around 40s. Well, yeah, like I think around 38 or something like that, right? But the problem is, again, it's not below 35. But had I done the twin butterfly strategy, worst case scenario, I would probably, be break even, right? And then the other loss, big loss today is Palo Alto Networks. I was trying to play earnings. And so what I did was I have a long call butterfly, to take advantage if the price goes up. And I have a calendar spread if in case it goes down. I put my calendar spread at 155, which is, I think when I started this position, I was around like close to 170. And the expected move is $10, right? That's how I structure this. But unfortunately, it went down not just $10, not just $15. It actually went down $20, all the way down to 150. And because of that, well, first, the long call butterfly becomes basically worthless, so I sold it for zero. And then the calendar spread, because it's still below the 155 mark, then I still lost money there too. But the bulk of the loss came from the long call butterfly. So lost money there, not so happy with it, but it is what it is, right? And so, and then for my other account, which is the small account, and in the small account, I have I mean, today it's actually a good day for it. It's a green day for it, today. So where is that? Yeah, if I look, but overall, it's losing overall, right? Unfortunately, but again, it is what it is right now. So combined, like I am below the S&P 500, which I'm not very happy with that. But it is what it is. As promised, I share with you my wins, my losses, and what I'm learning in the process. Even the bad things, because that's what trading and investing is, right? So, but compared to a lot of people who lost money with tech stocks, my account is actually in a better position right now. So, which, a good segue to talk about drawdowns, right? The problem with the drawdown is there's a geometric, it increases geometrically the deeper your drawdown becomes. So a 10% drawdown. So for example, let's say, you have $10,000, right? And on paper, you've lost 10%. So that's $1,000, right? So in order to make up, that $1,000, right? Now it's 1,000 over 9,000, which is the current account balance right now is 9,000, right? So you need to make 11%, 11.1% to be exact in order to make up the $1,000 loss, right? Then, if you have a 50% drawdown, right? 10,000 to start with, and then now it's only 5,000, that's the value, right? Now you have a bigger problem, right? Because not only do you need to make 50%, you actually need to make 100%, right? Because 5,000 divided by 5,000 that is left, that's 100%. So just to break even, you need to make 100% return. And then lastly, let's say 90% drawdown, you need a 900% gain, right? So solution here is one, you need to limit your drawdown, right? So that because it's a lot easier to find stocks that will go 11%, right? Versus to find stocks that will go 100%, and it's very rare you can find stocks that can go up 900%, right? So if you limit your losses, that's one solution to be able to recover faster, right? And world-class traders, the champions of the US investing championship for, for decades and decades, right? That's one of their key strategies, right? Is they minimize the drawdowns, right? By having a very tight stop loss. For example, Martin Look, his stop loss is like 5% or even less. That's crazy, right? So but let's talk about like what if you already have the drawdown, right? What if let's say you bought Robinhood, you bought SoFi, you bought what else? MicroStrategy, you bought Meta, right? You bought a lot of the stocks, right? A lot of the common names, right? The Mag 7 stocks, right? And then today, I mean, with some of them, you're looking at a 50% drawdown, right? So now you need to make 100%, right? So, but I'm going to show you how to recover, you know, and a lot faster. And I'm going to show you the math behind it as well, right? So the solution, let's see option strat in here. So the solution is this, right? You can do a covered call on your stock, provided number one, let's say you don't believe in the stock anymore, you know, and you don't want to wait years, in order to recover, right? Now, if you think, the stock will recover quickly, then this is not the strategy that I will recommend, right? So you can double down, in order if you think that the stock will recover, right? You can double down to lower cost basis, assuming you still have capital left, right? But if not, and you think, let's say that the stock will probably recover slower, but you kind of want to have a like a lower break even, or to get out of the stock sooner rather than later, then one thing you can do is you can sell covered calls, right? Because when you sell a call, let's say you own 100 shares, you bought it for 150 of MicroStrategy, and MicroStrategy right now is $125.20, right? Then, as you can see here, by selling the 30-day call with strike price of 150, your net credit, you're receiving a net credit of $365, right? So, in theory, you can get that every month. Okay. Now, again, in theory, because things happen. And number one, the exact expiry date is not always 30 days, right? So depending on when you enter the trade. But let's say we enter the trade today, right? 30 days from now is March 20. That's the expiry date because the expiry date for MicroStrategy is only every Friday of the week, right? And so your $150 strike price, will give you $365 in credit. So if you do the math in here, you have a break-even calculator, right? Your monthly income is 365, the current price is 125, the cost base is 150 because that's what you paid for. Assuming you have 100 shares, right? You have a drawdown of 2,500, which is a 16.67% drawdown, right? In order to break even, when you sell a call and collect $365 in income every month, right? Then it will take you 6.85 months to break even, right? And as you can see here, the drawdown is about 17%, but to go back to break even, you need 20%, right? So that's one way is you can just sell covered calls. The downside is you are capping your gains, right? Because if MicroStrategy skyrockets to 200, well, the most you can sell it for is 150, right? Or you can buy back the long call, I mean the short call, right? But then you have a loss in there, So that's why I said, if you still believe in MicroStrategy, right? And you believe that if it recovers, it will recover quickly, then don't do this strategy, right? But if you like to minimize your losses and utilize the stocks you already own, right? And you don't want to shell out any more cash, then definitely this is a great strategy, right? So as soon as you collected, that income, and let's say the price of the stock went up, your break even is at $146.35, right? Instead of your break even being 150, if you just, leave it alone, right? Meaning you just let the stock recover on its own, then the break even is obviously your cost basis, which is $150 per share. But because you collected income, right, now your cost basis becomes lower. And the more income you get, right, then the lower your cost basis becomes, so that you're in about 6, 7 months, you will break even, right? So, and then, what if you want to do it a lot faster, right? So, in here, you will break even, you need the stock to go up by 17% to break even, right? So, let's go. One other solution is actually doing um a ratio spread. Okay? So, with the ratio spread, you buy, let's say, a $120 long call, right? So you're buying a call, so that's why it's a long call, right? You're going long on it, right? And because you bought a call, you can actually sell another call. So let's say in this case you sell two calls at 135 and you buy a call at 120, right? While still owning the stock. Based on this, your break-even point will be $134.80, which is, you know, your account or MicroStrategy only needs to go up to $134.80 or 7.7% for you to break even. But there's always a downside, right? There's no such thing as free lunch, right? There's always a downside, and the downside is now you've capped your gain even more, right? The most you can make is about $40. Okay? So, but at least your break even point is lower. So what is it that you want, right? A lower break even point, in which case you cap your profit even more, right? Or you want to make you want to make some profit, in which case you might as well just do a covered call, right? At a higher strike price, let's say 150. But if you want to lower your break even, let's say you don't really like MicroStrategy anymore and you just want to get rid of it, but if you just leave it alone, your break even is 150. If you do this setup, now your break even is less than that, right? It's you save $15.20, with 100 shares that you just save $1,500, right? So that's how you can think about it, right? So again, just like the first strategy of just doing covered calls, only do this if you don't like the underlying stock anymore, and you don't think it will recover quickly enough, right? And you just want out, you just want, break even as soon as possible, then definitely do this strategy, right? But otherwise, if you think MicroStrategy will recover and it will recover very quickly and you can wait for it, then don't do the strategy, right? But otherwise, this can be a good strategy to add to your repertoire. And one way in which options can actually help you repair your stocks that have suffered through a massive drawdown, right? So, with that, I think that's about it. If you've learned something new in here, right? If this has benefited you, uh, then definitely like this video if you think I've earned it. And if you'd like to learn more about stock options and you want to follow my US Investing Championship journey, you don't want to miss any of my videos, definitely subscribe to this video. And if you'd like to know why you should not buy the dip, but rather you should buy the rip, meaning you don't double down as the stock is trending down, but instead you wait for it to rip, and go back up, and then that's the time that you should be buying the rip. And to know the mathematical proof, of that, right? Instead of buying the dip, watch this next video, and I will see you there.